All right, let's dive right into this explainer and unpack the ultimate barometer of the Indian economy, the Nifty 50 index. Now, if you've ever tracked the Indian stock market, you have undoubtedly watched this number bounce around. But today, we're going to look under the hood to see exactly how this massive financial engine actually operates. So, what truly drives the market? Well, to understand where things are heading, we really have to peel back the layers of this index. It captures a staggering 66% of the exchange's float-adjusted market capitalization. That means this isn't just some random list of companies. It's a highly dynamic, rigorously calculated reflection of India's corporate health, representing the absolute largest and most liquid blue-chip stocks on the national stock exchange. So, here is our macro to micro game plan for today. 1. Birth of the benchmark. 2. The free float methodology. 3. Sector and stock heavyweights. 4. A resilient track record. And finally, 5. Looking ahead, current valuations. Okay, let's kick things off with Section 1, Birth of the Benchmark, the origins of India's premier index. Think back to November 1995. That's when the base date was set with an initial value of just 1,000. Fast forward a few months to April 1996, and the National Stock Exchange officially launches what was then called the S&P CNX Nifty. And today, it serves as India's premier benchmark. We're talking about the underlying asset for massive volumes of ETFs, derivatives, and mutual funds. It really is the gold standard. When you look at the official NSE indexogram branding, it's a great reminder of the strict governance behind the scenes. This signifies that the index is rigorously maintained by NSE Indices Limited. They act as the custodian, making sure it consistently aligns with true market conditions and the on-the-ground realities of the broader economy. Moving right along to Section 2, the free float methodology, the math behind the market. So, how does the math actually work? Well, the Nifty 50 utilizes a free float market capitalization methodology. Rather than just looking at a company's total size, it exclusively measures the shares that are actually available for public trading. It completely strips out locked-in shares held by founders, promoters, or the government. Why? To reflect true, actionable market liquidity. Let's break this down with a quick example. Take a hypothetical company A with a total market cap of 2 lakh crore rupees. If only 60% of those shares are public, its free float cap is 1.2 lakh crore. You divide that by a total Nifty 50 free float of, let's say, 100 lakh crore, and company A earns a 1.2% weighting. Put simply, a company's impact on the index is directly proportional to its actual market presence among everyday public investors. Which brings us to Section 3. Sector and stock heavyweights. Who runs the Nifty? If we look at the sectors, financial services absolutely dominate the index weight at a massive 35.45%. This is followed by oil and gas at nearly 11% and IT at 9.4%. Now, while the index is diversified across 13 to 14 sectors in total, these specific heavyweights act as the undisputed engines of the broader market momentum. They drive the bus, for sure. And when we look at the individual stock heavyweights, it becomes super clear who the true giants are in the room. Companies like HDFC Bank and Reliance Industries command incredible influence, sitting right at the very top. Depending on daily market fluctuations, the top 5 stocks alone, which typically include HDFC, Reliance, ICICI, Infosys, and TCS, can account for over 40% of the entire index weight. Literally, if these stocks sneeze, the Nifty catches a cold. But hey, it's not just about the top 5. It is vital to spotlight the fundamental performers driving long-term momentum based on 5-year profit and sales growth. Standouts like Max Healthcare and Trent represent the modern additions to the Nifty, reflecting shifting consumer and healthcare trends in a rapidly growing India. We also see incredibly dynamic players like Shriram Finance, which was noted as a top past-year gainer with an explosive surge of over 56%. That really rounds out this robust portfolio. Let's shift gears to Section 4. A resilient track record, analyzing the scoreboard. 12.41%. That right there is the compound annual growth rate of the total return index since its inception. By factoring in both price appreciation and reinvested dividends, this number is a powerful testament to the long-term wealth compounding power of holding a basket of these 50 blue-chip stocks. Tracking these milestones year by year from 2021 to 2025 shows us exactly how the index navigated some pretty extreme volatility. Look at 2021, a phenomenal 25.6% return driven by post-pandemic recovery. Then, in 2022, facing high global inflation and aggressive rate hikes, it still managed a positive 5.7%. Following up with another massive 21.3% rally in 2023, and steady growth in 24 and 25, this clear cycle maps out robust economic expansion and consolidation. That kind of resilience is exactly why retail investors and institutional fund managers alike trust the Nifty 50. It acts as the ultimate tracker of economic expansion. Despite the inevitable short-term global disruptions we always see, the underlying earnings power of these top 50 companies provides a remarkably reliable anchor for the Indian equity market. And finally, Section 5, looking ahead, current valuations. Right now, based on recent analytical estimates, the index trades at a price-to-earnings ratio of 23.9 times for the 2026 financial year. Now, this valuation is fundamentally driven by the steady expected profit growth of these core companies, showing us that investors are absolutely willing to pay a premium for the consistency and sheer dominance these 50 corporations offer. Looking ahead, analysts have set a base case target of 29,120 by the end of calendar year 2026. This optimism is underpinned by an expectation that the profits of the Nifty 50 companies will grow by 8.2%. So, that 23.9x PE ratio, combined with this ambitious target, highlights continuous, strong confidence in the long-term compounding machine that is the Nifty 50. I'll leave you with this thought to ponder today. The Nifty 50 is a living, breathing reflection of India's overall growth. As new, highly innovative sectors rise up and traditional ones are forced to adapt, the makeup of this index will inevitably transform. So which visionary companies not currently on this list will rise up to dominate this iconic index tomorrow? It's a fascinating space to watch. Thanks for joining me on this explainer, and definitely keep your eye on the markets.